Welcome back to the Steadyhand YouTube channel where we make investing a simpler, more enjoyable experience. Today, I wanted to address a question we get quite often at Steadyhand and one that my colleague here, David Toyne, is an expert at explaining. And that's the question, what is book value? David, you get this question all the time. I've seen you explain it in really, understandable terms. Help investors understand what is the difference between book value and something else they see on their statements or their portals, market value.
Right. Well, it's a great question, and thanks for involving me in this conversation, Salman. It can be a little bit complicating and confusing, but it's really not that challenging once you get the grasp of it. First off, market value. What is market value? Well, market value is the value of your holdings, whether they're a steady hand fund holding or an ETF or a direct holding in say a bank stock or something like that, and it's as of a period in time. Most typically, it's as of the last night, the last trading period. So the market value of the steady hand funds are calculated as of the last trading day. So if today is a Tuesday, for example, the market value of your holdings as shown in your portal would be as of last night. And that market value is calculated based upon all of the securities that are within the steady hand funds at their individual market values, all accumulated and put together into one, what we call net asset value. So that's the market value. The book value, or the adjusted cost basis, or ACB, of your holdings is different. And often people think that that is the cost that, or what you paid for your investment. So perhaps what you paid for the Steady Hand Builders Fund, or what you paid for shares in Royal Bank. But it can be, but it's more likely not. And we can talk a little bit about what that ACB and book value is. But it's really important to understand that it only is important in a taxable investment account. So if you're looking at your TFSAs or the new FHSA or your RSPs or LIRRs and things like that, you don't have to worry about this calculation. And secondly, you only have to worry about it if you're thinking about redeeming units from a taxable investment account. That's the only time you really have to calculate it, because it will have an implication on the taxes that you have to pay. And then thirdly, it's not to be confused with the performance of your investment experience. That is a more complicated topic, probably for another video.
So let's get into some of those. So market value, if the fund I held just owned one stock and that stock was last night closed at $100, then the market value of my portfolio would be $100. It's just what it last closed at. And
Right,
if you own a stock right now, what it's trading at this very moment.
right.
Um, what does book value include? If it isn't just what someone paid for, what goes into the calculation that makes it different from what someone might have paid for that fund or the stock?
Sure. So again, remember, this is only related to taxable investment accounts. And the reason it's important is because at the end of the day, you will pay taxes on the income that you earn either through dividends or interest income, or through realizing capital gains through the disposition or sale of your shares or your units in a pool fund, for example. So in order for the tax calculation to be correct, we need to add to what you paid for the shares. So the $10 you mentioned earlier, or did you say? I think you said $100.
$100, yeah.
$100. We need to add to the $100 any income that we've earned. For example, a dividend, or in the case of a pooled fund or a mutual fund, a distribution that we have then reinvested to buy more units. So there's dividend reinvestment programs where you can take the dividend, and instead of taking that in cash and spending it, you can buy more units of the company. And that dividend needs to be added to your book value in order to calculate the new adjusted cost basis of your holding. If you get distribution from your builders fund or your founders fund units, for example, and you reinvest in buying more units of the fund, which is what typically people that are saving for their future do. Well, that reinvested distribution needs to be added to the cost of what you paid for those units in the first place. And so you'll find that the book value starts at $100 in the case of that bank share, or maybe it's $12 in the case of the builder's fund, but it goes up and up and up over the course of time as you continually add these distributions that are reinvested. And the reason that happens is because when you get the distribution or the dividend in a taxable account, irrespective of whether you take it in cash or you reinvest it, you will be taxed in that tax year. And so the tax authorities, in order so that you don't pay taxes twice, allow you to add that distribution to the book value so that when it comes time to sell the shares or the units, you're not taxed twice.
So important points there worth noting is that yes, it really impacts those holdings in people's taxable accounts, and it's really useful for folks that are reinvesting their distributions and dividends. Um, and now at Steadyhand, we do something else. The book value isn't just just the distributions. There's another element to it which is worth noting, which is our fee discounts. So
Right.
most Steadyhand clients get fee discounts by virtue of the the size of their portfolio with Steadyhand or how long they've been clients. And so we add those fee discounts to your book value,
Right.
which also adjusts your cost base upward as well.
Right.
So that's worth noting for Steadyhand clients specifically.
Yeah, very fair. And again, I just want to reemphasize that it's not as simple to calculate your performance as being the difference between your ACB and your market value. And that's something that a number of people tend to fall that into that trap. In fact, calculating performance, as I say, involves not just the value of the fund units in your account, but also the sequence, the time with which you have either acquired or disposed of those fund units. And that, as I said earlier, is probably a subject in and of itself for a separate video.
Yeah. And for Steadyhand clients, we try to make that very clear on your statement. Um, we tell you how much you've invested in the portfolio, in your portfolio, what the gains or losses have been,
Right.
and what the final market value of your portfolio is as of a certain date. What are the two or three things, quick summary, that people should take away when they're looking at their statement on this issue?
Again, focus only on this issue as being relevant to taxable investment accounts. Don't worry about your TFSAs, your RSPs, your LIRs and RIFs, et cetera, et cetera. That is another issue of taxation, most of which are either tax-free or tax deferred, but it's not related to the ACB versus market value discussion today. Secondly, understand that a rising book value is a reflection of the fact that you've already been taxed in the calendar year that you've received either the dividend or the distribution. And so this is a good thing. To have a rising book value means that you're not going to pay additional tax when you end up disposing the security at some point in the future. And beyond that, I just repeat and say book value, adjusted cost basis, they're the same thing. Market value, obviously the value of what the securities are at the most recent trading or calculated place and time, but they're not performance. That is a whole nother topic.